Guys, welcome to another Connectivity with Success. And yes, welcome to another day talking about the stock market, cryptos, bonds, credit, and what's going on with the stock market in general. And everything that has to do with making money online. If you like the video, please click like, subscribe. Let's fucking go. Let's go. Let's go. 9th of July 2020. In the last 24 hours in general is uh, earnings report is what every company has been reporting on after every 4 months, how much they made and what's actually going on in their company, improving or are they just masturbating all day in the office. So yeah, man, here's the 29. What's been happening? It's very choppy, it's very mixed. No one knows what to buy. Selling off due to the US and Iran war. So this renewed Iran attack on US forces overnight. All missiles interpreted sent oil prices higher, obviously, and pressured risk assets while everyone waits on the FOMC decision this afternoon as in of midday, and the S&P 500 was Nasdaq as well is flat. So just to make it sweet, short, and simple. Everyone is just bleeding. So yeah, man. Even the Dow Jones also was down by 1.6, more than 850 points. So which is bad. Yeah, man. If you had 1,000 right now, you'll be on 500 or 200, right? If you were trading. So yeah, man. Since the Dow Jones carries few tech names and semiconductors are getting hit the hardest, um, most So let me just show you the commodities, something you can feel, touch, and smell. So what I was just trying to say there is that Iran missile, Iran basically just lost the US. So everything is just, yeah, man, down, dude. Plus, these apps where you can actually track what's actually going on in real time in terms of like, was there actually a missile blown? Was there actual missile? And were the people going to the hospital? I mean to say, it was confirmed basically. So ever since they threw that missile, shit has been bleeding. Literally everything is red behind me. So commodities is something people have been investing in when the stock market is down. So they have this inverse relationship. So when the stock market is down, people normally buy heavy metals, right? Uh, which is normally, yeah, you can see here, you can see gold is higher, silver is up by 1%, copper is just a bit down, platinum is down by 1%, Brent oil is up, WTI is up, natural gas is down. It's just down just a little. And then heating oil obviously is one of the biggest winners of the year. Literally is up by 5%. So let me show you back to 80 price now, currently at this current moment. So WTI as well is at 84, natural gas is at 2.7, heating oil is at 4.2, right? So yeah, man, when basically the stock market is down, heavy metals like commodities, something they can actually touch and see, because normally that's what that's been happening for years, and recession happening or sell off, people should just run off to commodities. And then also your VIX, which shows you the VIX shows you that the mass group, right, are selling overall. So it's here today, it's currently sitting at $19.44. It's up today by mostly 6%, as you can see. So it went from that 16 to 19 basically. And the other thing that is down today is the US dollar. But year to date, it's higher. It's currently sitting at $119 today. And that's what's been happening there in overall. So we're just waiting for the Fed, Mr. Kevin Walsh, to tell us what he's going to do just to stop this bleeding, basically. So Walsh is like, how can I say this? Kevin Walsh is like when Kevin Walsh and investors and traders is like a relationship between your parents and you as a kid. So every time, let me not say you, let me just say a rich kid, a spoiled kid, um, under a rich household, right? Every time he gets into trouble financially, he's expecting his parents to save him. So Kelvin Walsh is like the parent for every investor and trader, basically. At this current moment, that's what's been happening. And then moving on to other factors, which are crypto bros. The cryptos were also supposed to go higher actually, due to it is also seen as a safe haven. It might move with the stock market, but nobody is seen as a safe haven. So yeah, man, that's what's been happening there. So with the cryptos, are basically holding up very well as a risk of tone. It's up currently now by 0.75%, roughly holding to that 64 4,300. And then, yeah, man, it's holding due to the meeting of the Fed Reserve with inflation sitting at 41, keeping a hike on the table. So higher today is Ethereum. So yeah, man, that one is playing around 1,900 to yes, 1,900. Yeah, man, this one is currently just sitting there up by 0.3. Ether is down today. Bitcoin, obviously, Binance is up because of it's an exchange for Bitcoin. USDC is higher. XRP is up by 1%. Solana is down by 0.13. Tron, which is an exchange, is higher today. Hyperliquid is also to exchange cryptocurrencies. Yeah, man, that's what's happening there. So in total, cryptocurrencies are sitting at $2.28 trillion, which is up from that $2.26 trillion. So the fear and greed index is reading fear territory. So yeah, man, traders are essentially frozen, waiting for the Fed statement overall, right? Yeah, man, that's what's been happening there. So like I said as well, the US dollar is down. So other currency pairs are higher today. So yeah, man, the ones that are performing today is the US dollar to the Swiss franc, British pound to the Japanese yen, the British pound to the dollar, the euro to the yen, the euro to the yen as well, and then the euro to the US dollar. So that's today. And moving on to your one of the biggest markets in the entire world, because there's literally trillions and trillions of dollars of that, and it's one of the biggest due to the people who invest in it, which are pouring in gold. majority of the times. The bonds now, you can see the 30 years currently sitting at 5.1%, 10 years sitting at 4.6, 5 years sitting at 4.4, and then the 2 years sitting at 4.3, right? So yeah, man, more or less with the by 3 basis point, which that's why now sitting at 4.6. The 30-year gained 2 basis point. That's why it's sitting at 5.1%. All pushed up by the oil prices was one of them, and a war risk premium ahead of the Fed meeting. So yeah, man. So more or less today, widely to hold the interest rate between 3.5 and 3.75%. So yeah, man, the markets are pricing in at 76% of a September hike, an unusual probability of a near tightening for this point in the cycle, and the higher year-end yields are waiting on a rate-sensitive sectors. Rate-sensitive sectors are like your housing, right? The housing, the small caps, and the high multiple tech companies. So yeah, man, that's what's been happening there and overall in terms of the stock market, right? And then we're gonna jump through in terms of actually the biggest sell right now are tech companies, which are your semiconductors. Semiconductors is mostly everything that has to do with AI, basically, just to make it sweet, short, and simple. The chip that make your laptops, cars, right? Laptops, cars, and etc. Right? Those are chip companies, and also trickling down to other companies and countries. So yeah, man. Overall, this year we see this company, this South Korean company, also got we got another beating today in terms of the earnings report. So as you can see here, it just recovered literally just a little bit by 0.25, but their earnings. So what happened is they reported an earnings of 52, 54, 54.6 billion, which was higher. And then operating margins were at 76%. Net profit was $6.6 billion, boosted by investment. There's still enough. So yeah, man, the stock today was hammered by that news by 9%. So just basically right now trying to meeting is coming soon in the next 30 minutes. So yeah, man, that one got hammered today. As well as Samsung, the the Japanese family company. You can see here, this one is down by 5%. I wonder if there's a Samsung ADR. ADR, no? No, there's no Samsung ADR. So this one got hammered today as well. So there's just a trickle down. So Samsung was down by 13%, and the Cosby was down by 6%. They also had a sell off today. Not a little. They got hammered today. They got raped with no Vaseline. So yeah, man. Today, what's been happening is more or less of a classic priced for perfection. Guidance wasn't perfect. Guidance wasn't perfect enough. So the reaction was just a sell off basically today. So every member of the semiconductor index is now trading below the 50 moving average for the first time since April 2025. The index overall is down by 19%, making semiconductors getting obliviated. Semiconductor index. So yeah, man, this one, here we go, the Philadelphia semiconductor index. So here's it here. So all these semiconductor companies, etc., they also get obliviated this week. So yeah, man, like we said, all these right before below, making it one of the lowest since April 2025. Um, the index is down by 19%, making it one of the worst since 2009. And as well as the semiconductor ETF has seen $1.3 billion of outflow yet. Yeah, man. So more or less that's what's been happening there. And one of has been important and every trader and investor has been looking at right now is the report. Like one of the most important thing to look for. It's very important to know that. So yeah, man, one of the biggest one was the SK Hyndex. It crushed on operating profit. It was up by 555. So yeah, man, you made a lot of money on SK. It slightly missed on revenue. Their revenue, so this is a metric that makes or breaks the company, right? So every investor slash nano. So that's what they make basically. That's what they, so that's what the investor looks at just to see if the stock is gonna go higher or low. So yeah, man, the pricing is still ripping basically in terms of and then the HBM4 shipments started and full ramp in Q2 basically. So yeah, man, they just gonna ship a couple of their this month basically. Bloom Energy. Here we go. There we go. This one loses with SK, right? This one, what happened was this thing was actually down by 10%. Now it's recovering up by 3%. Bloom Energy, what happened on the earnings report is that it was up by 166%. Year to year, it made $1 billion. So yeah, man, EPS is up by 680%, and it raised a full year guidance, citing hyperscaler and AI data demand for its power systems. Despite that, the company was down actually by 11%, but it seems like they just said, you know what, I don't care what you say. Happening there with Bloom Energy Corporation hired today, as you can see. In the beginning, when the stock market started, but as you can see here, if you invested in this company a year ago, you could have been high by 400%. Wow, that's amazing. And then another one we are looking at today is Ford, the one and only Ford. Ford is the company that makes pickup trucks. Yeah, man, it's one of the biggest sellers, right? Their main points is pickup trucks, right? That's what they make their money on. So this one it's high by 3%. You get stuck at $4 every single fucking day, dude. Above the four. But yeah, man, things have changed like anything else. It's like one of those things like people didn't like cell phones. Now everyone is using them. Now the people who wait, people didn't like cell phones, right? So the people who said they don't like it are the ones who are posting more on the phones. That's funny enough. It's one of those type of things right now. Climbed by 5.6% on Ford in the pre-market after a strong beat on Q2, and they raised their full year guidance. Full year guidance meaning that they're no longer gonna make 40 44 to 44.7 billion. That's what they expect. And then our EPS is gonna be 42 versus the 36, right? People who invest in this one, man, they make a lot of money. And another company that has almost every fucking year, um, company Boeing. So this one also climbed higher today by 4%, despite a wider than expected loss, because the revenue came in at 24.56 billion, 4.56 billion. Now it's down by 2%. But yeah, man, this one every day it's always catching smoke about something. There's always something wrong with this company. But yeah, man, they did like the investors are not fucking, and as well as the gas prices. It's down due to the gas prices. That's the main and the cost in relation to how much money made. It's gonna go lower. So basically, they're just gonna make less money with the higher gas. And also reported earnings was a Coca-Cola. Coca-Cola company that's been dead for a while. It's been high, low, high, low. One Coca-Cola, their EPS, very important. So it's getting at what? It was by 0.67%, 8% basically in terms of their EPS. Revenue is another company, a lot of investors like that. So it also reported earnings by 8% due to that, and then they also beat their Q2. That seems that like other things, what's going on within the company. Now it's down by 2%. The ones we expected before the closing bell today is Coca. No, it's not Coca-Cola. It's Microsoft and Meta. It's going to report this week in general, as seen as a major test for AI capex sentimental. So yeah, man, that's what's been happening there in terms of earnings report, right? And then more or less in terms of merge and acquisitions, mergers and acquisitions are very important because a small company is being bought by a big one. It's important. You're gonna see that company normally, if it's being bought by a big company, it's gonna go higher by like 10% if the investors see it as a good deal. If it's unhealthy, it's gonna get raped down even further. So far, we've seen in terms of merger and acquisitions 47 deals, which is higher by 10 billion were announced in the first half. So the first half from January until July, right? And then totaling basically 1.3 trillion dollars, with tech the largest sector at 449 billion dollars announced in transactions. So one of the biggest deal today was one of these European companies buying a small company for 2.3 billion. Finnish utility was the company, 2 billion. And another one was a company called Fire Energy, so another European company, is buying a small company for $1.3 billion. The name of the Europe, one of the European largest oil and gas companies in there of acquisitions. And then more or less everything waiting for reserve. Yeah, that's it actually. So overall, just to quick simple what's been going on is with oil and Iran risk, Federal Reserve with genuine uncertainty. Just to summarize everything, we are waiting for Microsoft and Meta. Meta is Facebook basically. So all the coverage that's been happening right now is that. Yeah, man, that's about it. Like that moves like a fucking hell. Let's see if we can just look at that today. Yeah, you. Let me just turn on YouTube. Let me see on YouTube if we can find a Federal Reserve. So this will be his first ever meeting actually. Let's see. So this is a 50 thing, right? What you're gonna see is if this guy said he's gonna cut rates, the stock market like literally in a second. And it's gonna change. And if he says stock market go higher, if he increases rates, they're gonna bleed even more. So if he's gonna say anything about supporting the market, yeah, man, you're gonna see that as well. Let's see. Yeah, man, we're gonna wait for that in the next like 10 minutes. 20 seconds. T defense. So, just to summarize, right? The Federal Reserve, what is expected to do today is hold rates steadily at 3.5 to 3.75%. So this will be the fourth meeting in a row without a cut, right? So which is good. So notably, it's the chair Kevin Walsh's first ever meeting running the show. He's taken a cautious and a low guidance approach so far, and he is part of why there's much uncertainty than usual around this one, right? Everyone likes power, bro. Be like 3 months ahead. I don't know how people knew that, but lifestyle, what he ate, who he hanged around with, board members were. It seems like they knew everything about them before the meeting happened. There. Just to summarize, is that the markets are pricing something like a 30% to 35% probability of an actual rate increase today. So, so yeah, man, a rate increase, meaning that the cost of living is gonna go even higher. So, sweet, short, and simple. That's a striking number that is close to a meeting. So this will be the first rate hike in 3 years if it happens. If it happens. So yeah, man, the intentions. Inflation has been running hot, right? Which is around, and the fresh escalation with Iran has pushed oil prices above 90. It revived the inflation fears, which urged for a which they love already. Is hawkish. The Fed investors really hate. But yeah, man. On the other hand, is that growth data has been cooling. Private hiring has been slow for 5 straight weeks, and some growth data has been cooling, and our private hiring has been slowed for 5 straight weeks. Some early signs point for an easing inflation, which urges against tightening into a softening labor market, right? So just to make that sweet, short, and simple, is that um, to reduce the cost of living, basically, just to reduce the cost of living at least, because everyone is suffocating. The economy is quite bad. The U.S. economy is quite bad. And then what happens if they hold, right? If they hold, right? Traders are pricing in above. This is basically like a 76 to 80% chance of a hike in September. So the more important thing to watch this afternoon may not be the rate decision itself, but the voting split. Are they hawkish or are they positive? Which will tell us in September the odds, right? Walsh's tone, his language on inflation persists, and the war economic impact will move markets more than the decision itself, and as well as the statement characterizations of the Iran conflict, whether the Fed treats it as a transitionary oil shock or a durable inflation risk. Out that this is and the war and this is not going to end anytime soon. Everyone has accepted that part. So yeah, man, more or less why the markets are on edge either way as a hold with a hawkish language. So three ways this might happen, right? Three results, right? A hold, right? A hold with a negative language could still hit the stock market and the bond market, since it confirms that September tightening is basically locked in. A surprise in a rate hike today will be a bigger shock. This has happened in 3 years and would land right on top of a active war risk premium in oil. Either way, right, the 10-year yield is already high by several basis points into the decision, and small cap companies, which are very sensitive sectors, are especially exposed given how much of this year rally has dependent on rates staying low. So the Federal Reserve is a very important factor in terms of the stock market. It has always been, it'll always be, and it always has been. So yeah, man, cautious, a hold. This will make it one of the most genuine, uncertain Fed decision in years, largely because of Kevin Warsh's way of thinking and the collusion of sticky inflation with a live geopolitical shock. They haven't long enough. They have with Fed, what's his name? The previous Federal Reserve, where they studied everything about him, bro. As soon as he said something, people automatically. So there are these like AI models people use to like the Federal Reserve tone, they tone and they speech. So basically, they just take that speech and like what stocks to buy. That was fantastic, doc, to see. So yeah, man, uncertainty.
To actually get them more concerned that they need to make a move and take a step there.
In defense of Chairman Warsh, we're all going to be waiting on the data now. I mean, the data is incredibly important through Jackson Hole onto the next meeting.
The curious case of this particular meeting, TK, is that we looked at the data and it was softer than expected on CPI and PPI. And there was a feeling that we would move on. And we sat around this table at the time when the data dropped on Bloomberg Surveillance, on Bloomberg TV on that very morning. I sat there with you and we both said the same thing. It removes the urgency to hike. It won't kill the story. The debate continues, and the debate does continue even this afternoon, and now we're talking about September, and maybe September's the date, and this is the direction of travel. Story just won't go away.
Take a look at earnings. Earnings have been on fire, and it's not just in the tech sector. It's across the board. The equal weight's outperforming also because of a fundamental kind of bleed up. And
regional banks in this country.
I mean, really, it's something that's
almost
more significant, so sufficiently restrictive. If you're looking to crimp growth in any capacity or looking for a slowdown, it's not happening.
Bob, I was going to say final word, but you might be sticking around. I have no idea how long this news conference will be, but give us a final thought on what you'll be looking for through what is not a sleepy summer.
I think the Fed got it right today so far. We'll see if there's a press conference and what gets said or not. I'm particularly glad with the fact that they've listed the 3 dissenters. Let's assume that the vote had been 7-5 in favor of a rate hike. By listing the 5 dissenters, we would know the 7 people who voted for a rate hike, and we'd sit there and go, we got 2 or 3. Where did the other 4 or 5 come from? What were they looking at? They didn't say any of this 2 weeks ago. What changed their mind? Is it all emotion? And I think that's a great regulator to a central bank and prevents them from just acting on emotion.
Bob Michael of JP Morgan Asset Management. Bob, thank you. I'll be back with you in 5 or 10 minutes' time. This news conference is about to begin in about 60 seconds from now. A newly minted Fed Chair Kevin Warsh will appear for his second press conference, widely criticised last time around, not for his refusal to offer forward guidance. That's gone. We've moved on. But his refusal to articulate his so-called reaction function. I think 3 dissenters at the Fed have been pretty clear about how they think about the incoming data and where they think policy should be.
I think Mike's question earlier is a really important one. How do you consider oil, and how potentially does the increase in prices affect your view, considering it does tend to be a one-time shock? But when you have rolling shocks, there is another type of dynamic that takes hold, and that is what we've seen.
I'm not a big gambler. In fact, I'm against betting. But I will ask this question. How many trading floors right now do you think are taking bets about how long this news conference will be with Kevin Warsh?
I think that's the question. I think we're taking bets right now because we're trying to figure out, for programming reasons, who we're going to have to book afterwards.
What's your number?
I think it's going to be. I think it's going to be 45 minutes.
And seconds, Bramo. 45 and how many seconds?
45 and 32 seconds.
TK, you playing this game?
I'm not playing this game, but
Okay,
I can just imagine Kelsey Barrow at JP Morgan with Kay Hare. They're all around the terminals, you know, betting here. They're probably in one of the 14 restaurants.
Kelsey's running the book at JP Morgan.
Yeah, I think she's running the book. They're probably in a bar over at their new skyscraper.
The man himself walks into the room. Kevin Warsh, Fed Chair, in front of the podium following an unchanged decision, but with 3 dissents. Let's take a listen.
My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission-focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting, a choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake, that the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. There's only a target, and it's 2%. Not one of my FOMC colleagues is under any illusion. We have begun a new chapter, and we understand that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases. This Fed will not waver. Our credibility rests on performing our duties and delivering on our responsibilities. Americans are right to expect that because our nation's prosperity depends on it. To the regulars here in the press room, today's assessment might sound familiar, yet there was nothing inertial about our discussions, our policy, or our strategy. 2 economic developments are worth highlighting. The first is a very notable change since our last meeting 42 days ago. Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades, ranking around the top decile or so. But if the committee didn't change its policy rate, what happened? In the intermeeting period, market attention centered on real data and real economic developments. Prices reacted in real time to incoming information. and the reduction in forward guidance may have been a factor. Market participants are learning to play the ball, not the referee, and market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I understand the desire for rolling forecasts and commentary from this committee, but for our part, we need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. A second economic development is one that I noted at the congressional oversight hearings this month, but it's worth repeating. The most striking feature of the economy is the strong growth of business investment. The surge in high-tech CapEx has been remarkable, but that does not necessarily make the Fed's role any easier. In the AI-related category of high-tech equipment and software, the most recent data shows four-quarter growth rates of nearly 20%. This is helping to sustain the healthy momentum of manufacturing output. More generally, CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. FOMC meetings produce policy decisions, but just as important is candid discussion of the big things that matter most. That too is a priority in this new chapter at the Fed. In our meeting, vigorous discussions centered on four questions, which I will enumerate. First, we talked a lot about the implications of the past 5 years of high inflation on the current policy conjuncture. To echo an old phrase, has the past really passed? Second, my colleagues and I considered the economic shocks of recent years, strained supply chains arising from the pandemic, military conflicts, energy supply disruptions, substantial increases in tariff rates, and yes, the surge in AI-related investment. These differ in their sources. Do they also differ in their effects on output and employment? Third, we took up the related question of price increases arising from shocks. The business CapEx boom, for example, is driving up prices of memory and logic chips and associated AI infrastructure. Do these changes indicate a broader inflationary dynamic, or do we just focus on them because they are under the bright streetlight? Finally, we discuss monetary policy tools and strategies for achieving stable prices. If, as the Fed has long held, interest rate policy should be its primary monetary policy instrument, how much accommodation are we getting from the balance sheet? In all of this, our work is advancing at the Fed. We're asking the right questions. And in this consequential time, we know how very much depends on getting the right answers. Of course, you've all arrived with questions of your own, so let's turn to them now.
Let's start with Steve.
Thank you for taking our questions, Mr. Chairman. Sure. You've had a couple months now, or 9 weeks, or whatever number it is, to see the markets behave in the absence of forward guidance. I'm wondering if you could tell me, what message are you getting from the markets as to where policy ought to be right now?
Yeah, so I think officially it's 8 weeks and 4 days, but I'm not counting. The message from markets is the message from markets. What I've really been trying to do, Steve, as I think you appreciate, your colleagues appreciate, is getting an unfiltered message from markets, getting a direct message, letting buyers and sellers meet at prices for treasuries, for the foreign exchange value of the dollar, and then trying to judge for ourselves, what does that mean about our remit? How are we doing on inflation? How are we doing on employment? We're trying not to interfere with that market signal. That's part of the reason why we've been somewhat spare in our words, why we pulled back from forward guidance. So they're reacting to events, I would say, much more directly over the 42 days since we last met. This is a good thing. As I mentioned in the prepared remarks, we've seen a material tightening, not just in nominal rates, but in real rates too. And we're observing it. We're trying to stay out of that because, many of you might be interested in our reaction function. We're interested in the reaction of financial markets.
I get that, Mr. Chairman, and I guess the follow-up question is, if the markets are talking to you, what do you hear them saying? And if it's real rates are higher, it would suggest that that's where the funds rate ought to go.
Yeah, so
Sorry.
I'm sorry, it's your question. So interpreting markets is an imperfect business. We central bankers, like market pros, can think these things are overdetermined, but let me offer some speculation. First, as we said in the FOMC statement that you got at 2 o'clock, the economy output is solid. CapEx and productivity are strong. Labor market's solid, steady. The bond market, the treasury market, it seems to be saying that as well. If I were to try to break down, disaggregate the treasury market signals, I wouldn't be able to do it perfectly, but the bond market's saying many of those same things, and that's why we're seeing a tightening both in nominals and in reals. Even while at some level we haven't done much in 42 days, the markets have done quite a bit.
Claire Jones, Financial Times. You seem to have got the family fight you were after at this meeting. We saw three dissents. Could you characterise the arguments that those dissenters put forward, please, and tell us a little bit why you weren't persuaded by them at this stage? Thank you.
So I guess I shouldn't give you their best arguments. I'll give you some others. So you were right. I asked for a good family fight, and I got one. That's the purpose. That's the design feature. I come into this meeting, even this press conference, heartened by what I've experienced the last 2 days. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star. So there was a lot of agreement that I heard that we have the powers, the tools, also the authority to deliver stable prices. No walking back from our responsibilities. There was a large majority support for the decision that we made in the room. But I also want to leave you, Claire, with one other impression. There was nothing inertial about that discussion. It was an active, robust discussion about what's in the full range of what we can do and might want to do in the period ahead. You characterized accurately there was a disagreement about a decision today. I would say that doesn't sort of capture the full essence of the discussion. The path to central bank heaven requires delivering on our remit. These days, that means delivering on price stability. I wouldn't measure that path in 42 days or any one particular meeting, and I came out of that meeting even more confident that this is the right team to win the battle against high inflation.
How much do you think not going in July was down to the cool CPI print for June?
So in 2 words, not much. Not much. I'd like to believe that the committee shares my views, which is the historic problem with data dependence is the data and the dependence. We are not relying on any one individual piece of data as cover or as an excuse or as validation. What I care about and what I think the committee cares about is trends on the data. Sure, we got some encouraging inflation data. I think at the meeting 42 days ago, I said something like 63 months of inflation above target. I didn't say 64, though the final calculation might be a close one. So we'll be watching inflation data over the period ahead, but I also don't want you to leave the misimpression that we're sort of breathlessly waiting that. I've called for a task force to revisit both the private and public data we use to make our decision making. That task force is out doing their work. I'll be checking back in with them the next couple of weeks, but I wouldn't say we overly relied on any one piece of data, including that data, which surprised some a couple of weeks ago.
Hi, Chairman Warsh. Thanks. Neil Irwin with Axios. Thank you for taking our questions. So the Fed funds rate is now about 75 basis points below the two-year yield. Suggests markets think you'll have to tighten eventually, about 100 basis points below most Taylor rule estimates. You're hitting your employment mandate. Inflation stays high. Why should rates not be higher today?
There's a lot in there, Neil. So rates are higher today than they were 42 days ago. Markets have made decisions because we step back in part from trying to influence those. Market judgments have moved up on what nominal rates are across the Treasury curve. That doesn't mean we take them as by dictation, but we're observing them. So I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make. I'll see if I can put it this way. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. We'll be continuing to watch that market information, see how it responds to incoming events, and that can help inform our decision making when we meet in 7 or 8 weeks.
How would you characterize in the family fight the last couple of days of you and the other 8 members who wanted to hold? Was that a strong conviction or was that a hair trigger close call on holding versus tightening?
Well, I think the vote was 9-3. The broader discussion to my ear over the course of the last days showed a lot of agreement on the hard questions. The 4 questions I raised at the outset about what's really happening in the economy with the shocks and absent the shocks. What are our tools and our capabilities? What's the effect on prices on output? I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. So could people come to different conclusions? Absolutely. But my own judgment is this is a period of watchful thinking, not watchful waiting. And I think the score on that vote was unanimous.
Colby. Thank you. Colby Smith with the New York Times. You've mentioned that looking at the Fed's policy tools is one element of a 3-pronged strategy to address the inflation problem. So I'm curious how you view the effectiveness of those tools. If inflation is too high and not coming down, is the best remedy to raise interest rates?
So that was the discussion in the last 2 days. Is that the dominant remedy? If inflation continues to be elevated through the forecast period, interest rates could well be part of that solution. But I wouldn't say it's in isolation. I tried to describe in my remarks today the point that I made to the oversight committees a couple of weeks ago. I think there was a misimpression by some in financial markets, by some households and businesses, that central bankers like me, we set a 2% inflation target, but maybe we were more tolerable of a somewhat higher inflation target. In economics, we'd call that the revealed preference. And so might it have been rational for people to think, well, their inflation target's somewhat higher. What I heard in the last 2 days, what I've heard in 8.5 weeks is no. We will deliver the 2% inflation target. That is the committee's definition of price stability. So one way, absent the tools that you reference, to ensure that we get there is ensure that expectations are centered around the right number. And I think we made some progress on that. I am not suggesting we're done on that. It's worth reiterating. And ultimately, the business we're in, Colby, is performance. We are going to be judged by how we perform. And that's what we intend to do. The inflation target, making clear expectations is one part of it. Making sure we demonstrate we're responsible for it, we're not blaming as another. And our policy tools, like you referenced, is the third and equally consequential part.
How are you factoring the fact that a large portion of the inflation overshoot is being caused by supply shocks, as it's mentioned again in the statement? Does that blunt the effectiveness of rate hikes in your view?
First, on the premise of your question, it was almost as if you were listening to our discussion in the last day and a half. A lot of our focus was on trying to understand and identify underlying inflation dynamics amid shocks. We take these shocks seriously. There have been a series of them that have been hitting this economy. We're not looking through them and saying, oh, they don't matter. What we're trying to understand is to what extent are these shocks broadening in their effects, broadening in their impact on prices that are quite far removed from it. Our goal is to have growth that is broadening and inflation that is becoming more limited, more circumscribed. I'll be the first to admit the shocks make this job in this policy conjuncture a little tougher, but that's among the chief questions we've asked ourselves. And around the room, people have different views on it. I tend to think in the coming months we're going to refine that view and have a better judgment, and we're going to have market prices trying to help inform it too.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. I guess I want to drill down maybe a little bit. What specifically, in your mind, would be the argument then for a pause today?
So I wouldn't characterize what we did as anything like a pause. I would characterize what we did as a rigorous review of the economic situation. I would characterize what we did as a review of the big, hard questions. And I'd characterize it as a view of what our own homework is to try to resolve those questions in the period ahead. If you were to try to force a description that this was a pause, I would say financial market prices would take the other side of that. Financial market prices in this intermeeting period, they didn't pause. They reacted to the inflation data in one direction, strong economic growth in the other direction, and nominal and real rates went up. Did the Fed take an explicit change in its policy rate today? No, but I think that's the beginning of the story, not the end of the story.
And if I could, I did want to ask, not forward guidance, but looking forward. Traditionally, a Federal Reserve chairman uses the Jackson Hole Summit as a sort of a reset of monetary policy. How do you look at the speech that you're going to make in August?
I look at it like a blank piece of paper right now. I have not begun consideration with the incredible team here what would go into that document. I think you characterized it correctly. Historically, at least from my first tour of duty at the Fed to more recent periods, it would be sort of a setting up speech more often than not of what was going to be happening in the fall. I haven't made any judgments on that, but those are judgments we'll have to come to. If I could, in the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic. Did you do this by a quarter or do that? Ultimately, whether we deliver on price stability matters some, the decisions we make in 6 or 7 or 8 week periods, but they matter more. What are the big questions? What's really happening with productivity? What's really happening with demographics? What's really happening to the global economy amid the shocks? Haven't made a decision whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all the action we're going to have between September and December. I will tell you one other thing that I am doing between now and Jackson Hole, so I'm checking with those task forces. My first principle of establishing a task force is find the best subject matter experts anywhere in the world and put them together, especially put them together with other people who might disagree with them. In the next couple weeks, I'm going to be doing a check back in, giving them time to sort of think hard about their agenda, their debate, their schedule, and when they might be ready for prime time. I'll be doing a little bit of that checking, and that may or may not inform anything I have to say in Jackson.
Nick Timmeros of the Wall Street Journal. Chairman Warsh, I want to follow up on Colby's question about policy transmission. You've said there's no cruel choice between stable prices and full employment. Rates bring inflation down by cooling demand. It's generally thought that can show up in the labor market. If that's not the channel you're relying on, what is?
Yeah, so let me go back to first principles, Nick. I don't believe that either part of our mandate is generally at war with the other part. I do not believe that price stability and full employment is an either-or proposition. There have been policymakers over the last several generations who have thought that there is a strict trade-off there. That isn't my judgment. In fact, my judgment is if and when we deliver on our remit, we're going to be satisfying both prongs. We're going to have price stability and full employment. And in fact, if you want to do the most harm to the labor markets, you would run a period of high inflation that's variable such that employers, businesses, wouldn't really know what's going on. So I think the two parts of our mandate are equally important. We have no legislative orphans here. I've been talking mostly about price stability because we're doing pretty well collectively as a country, as policymakers on the full employment side. But we're doing considerably less well on prices. That's why we describe them as elevated, and that's what's taken most of our discussion. In terms of transmission mechanisms of monetary policy, I think different tools work through different transmission mechanisms. The interest rates work through lending channels and credit channels, maybe confidence channels and foreign exchange. The balance sheet probably works through some other channels like signaling and portfolio balance. We're keeping full abreast of all these tools in making policy. But if the suggestion is somehow we're going to be fine-tuning aggregate demand so it catches supply, that's not my mental model. I don't think we're great in the fine-tuning business. We're trying to get supply and demand in broad order, but really what we're doing as we sit here today at this press conference is I think we've got a reasonable sense of what aggregate demand looks like in this economy. We're inferring aggregate supply. We're making a judgment about what productivity is. And in some sense, there's a race between supply and demand. And the surge in business CapEx in and around AI, it's making that calculation a little harder to judge, but in the period ahead, we're going to be trying to judge just that.
And if I could ask, where exactly was the disagreement today? Was it about the inflation forecast, or was it something more around the risks, the tactics?
Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment. I didn't hear anybody walking away from it. The judgments as to how best to achieve the price stability, that was probably the question that we were trying to answer. What's the best move? What's the best strategy? What's the best way to achieve it? And a second question that was asked is, when do we need to make those harder calls? When do we need to make those decisions? And like I said to one of your colleagues, I was comforted that markets in the intermeeting period weren't reacting to us, they weren't reacting to dots or to speeches. They appeared more than ever to be reacting to real-time events. So they're gauging themselves how restrictive the Treasury curve should be. And that, I think, has been a useful development. We don't endorse any particular market move, but I'd also suggest we observe them with keen interest.
Janelle Marte with Bloomberg. Following up on that, there was more uncertainty in the markets about what the Fed would do at this meeting. To some extent, you might think that's what you want to see. But my question is about, is there a point at which you would not want to surprise the markets if they were pricing in something with higher certainty that was opposite of what you were intending to do? What are the risks that you see associated with that?
Yes, so it's a good question. Surprise is not the objective function. Surprise is not what we're solving for. We have a clear North Star. What we're solving for is how to make the best decisions. Almost everything else should be in service to that goal. By not spoon-feeding markets, by not previewing our decisions, by not sort of giving nudges and leans, my colleagues and I have found in the intermeeting period, what we're getting is the views from a very accomplished economist. That's the internals of financial markets. Instead of just repeating or echoing what we were saying back to us, they're giving us somewhat, not perfect, their own judgment. Surprises are not the objective, but at the same time, I would say we didn't come into this meeting feeling constrained by the full range of alternatives we had in front of us.
So some of your peers have continued to discuss how they think about policy decisions, and if you don't offer your reaction function or your way of thinking about it, how concerned are you that you're ceding control of the narrative?
So not very concerned. That's a short answer to the question. When some people that follow the Fed say, well, we don't want your forecast. We don't want your dot. We just want your reaction function. Part of me hears what we really want is your forecast. And what we really want is your dot. In terms of reaction function, let me sort of disabuse people of a question that may or may not be real and be out there. Any central banker, especially a central banker where the labor markets are more or less at equilibrium. Any central banker, when he or she sees underlying inflation moving higher, he or she is more inclined to tighten policy. Again, when you've achieved the other side of your mandate and you see underlying inflation falling, he's more inclined to loosen policy. That's my reaction function, and I don't suspect it will cause people to not continue to pry for more, because the truth is, for a very long time in a lot of countries, coming out of the 2008 crisis, we're in crisis mode. We were purposefully providing a lot of information, trying to provide a lot of assurance, trying to tell people exactly what we're going to do, offering forward guidance with clarity as if we're tying our own hands behind our back. Well, in crisis mode, that strikes me as a very prudent policy. But in more benign conditions, it strikes me as worth revisiting. But markets and market participants and reporters have learned to devour all that information, so I take seriously that the pullback of forward guidance requires some transition. Reform isn't easy, but our general judgment is going to help us make better decisions, and in so doing, satisfy our remit.
Paul Weissman.
Thank you.
It's coming. There's a mic coming.
So yeah, man, I think he said everything. He has said literally everything that needs to be said. Now, ever since he made that speech, the stocks are changing higher, actually. Nasdaq is higher by 0.17. S&P 500 is higher by 0.23. He said everything that needs to be said. He's more like Powell. then Bernanke. Yeah, man, as you can see here, S&P 500 is higher, Nasdaq is higher, just a little. So overall, what he was saying is, isn't now they had a vote, right? For the first time, as the Fed, as more or less as the Fed, right? So it was like a 9-3 vote, meaning that to keep the rates on hold. So now they are the same. So let's just see. Let me just show you here. So they kept rates on hold for now. So as you can see here, let me just show you the actual rate. So yeah, man, as you can see here today, it's sitting at that 3% to 3.75%. So it didn't do anything today, basically. Just kept them on hold. So yeah, man, nothing has changed there, meaning that it was more of like a hawkish tone, meaning he's like more positive. He doesn't care about the stock market, and this alone, it means that they might increase rates this year. And he's more of like a meaningfully different communication style than Powell, less hand, and he's more on data. He says he's more on data, and markets, the stock market have less anchor to, they have less anchor, and he doesn't care. He doesn't watch the stock market per se. He's more worried about the actual market, meaning that they're going to increase rates very soon. Increase meaning that your banks are going to go higher, credits are going to go higher, bank stocks actually going to go higher, interest rates, stocks are going to get affected, like your credit companies are going to go higher in terms of stocks. Yeah, man, those type of things are going to go higher. And then you're going to see more of like people buying gold than before. So yeah, man, that's what's been happening there in terms of the Federal Reserve. If you like the video, please click like, subscribe. Yes, no, maybe so. Let's go, let's go, let's go, let's go. Let's go, let's go, let's go. He said